Through the day, you've heard lots of things about the macro and all of that, but this is what you've come to hear, how you make money and how you beat the market. Three very experienced practitioners of all that with me. I don't need to introduce them. Raamdeo, Shankar and Nikhil, all of them you know very well. Nikhil's the youngest, but he's been remarkably successful with Zerodha over the last few years, so my hat's off to him for what he and his brother have achieved over the last few years. He's also the most handsome man on stage of all of us, by quite a distance, though Shankar would dispute that. But Shankar, what's going on? In the last year, 60-70% of the PMSs and the mutual funds who investors pay 2-3% a year to manage their money have underperformed the Nifty. When you ask them what's going on, sometimes they say, last year they said because it was commodity stocks and we don't own commodities. This year they're saying because they were those rubbish PSUs and we don't own them naturally. What's the right way to look at it? I mean, it's only when their blue chip HDFC Bank does well, they are expected to beat the market? How do you explain this kind of underperformance? The lack of alpha?
Yeah, so last 12 months, I think it was Adani Group which was the problem area.
Nobody had them.
Nobody had them. And to be fair, I mean, let's be fair that fundamentally a lot of the stocks that did well, particularly this group, could not be justifiably held in a fund structure. You could hold it in your personal investing because, you know, I mean, it's okay when then they go up 10 times or maybe 20 times. But there is no real, if you say fundamental on the ground reality because of which these valuations were deserved. I'm not disputing that that figure is incorrect. All I'm saying is justifying that for a fund manager to his shareholders, to his investors, to the unit holders, to the regulator, if something were to go wrong, becomes a major problem. So you cannot play every game that is being played in the markets. It's not possible. So to be fair, the underperformance has come because of this one major factor. The Nifty has done better because of this. If you look at the difference between the Nifty and the small cap, that itself is telling you a lot of things. That small cap on an index level has not done as well. So, but you know, I mean, the fact is there will be something that will do very well. People are underinvested. And the law of the market is very simple, that the money gets made where people are least invested. And there is no real reason why you should be investing in the least invested. But usually that's the place where you end up making most of the money. And unfortunately, the incentive structure for a fund manager is geared towards retention of assets and hopefully some growth. It is not really a structure in which you're being paid to take a fair amount of risk. And that stems from the investors into fund or PMSs. And I can tell you, you know, I've run these structures, and investors are the worst enemies, I can tell you this, because what they want is an impossible set of combinations. They want you to beat the market, they don't want you to lose money when the market falls, all in the same stock or the same group of stocks. That's not possible. These are impossible objectives to manage at the very same point in time. It's not going to happen. Right. And which is why you will find an odd fund which took the bet, let's say on Adani or in commodities. They will beat the daylights out of the market for a year. Okay? Whether they'll repeat it or not, you know, who knows. So the short answer to your question, Udayan, is that it's been a very tough environment in an organized form of fund management. Very, very, very tough. The headline index is not telling you what the underlying trade change has been. HDFC banks or levers or Asian Paints, they have been dogs, while the underdogs have become the big dogs. You know, welcome to the markets.
Yeah. Raamdeo, what about this trend of public sector stocks, which did very well? And many fund managers traditionally have not owned these names, the Coal Indias, the Power Grids, NTPCs. I mean, what do you do as a fund manager when you see these kind of stocks coming back and beating the daylights of your core blue chip holdings?
So it's a problem in the sense that the markets are markets and...
Is your mic working?
Yeah.
Yeah. You have to hold it closer.
Yeah. So markets are markets, and they will go, like, one of the things which is happening is that because of sustained fall in the interest rate, for last 10, 12 years. There was a method of madness in the sense that all kinds of growth story, whether it is profit making or not profit making, they were going through the roof. Just 12 months back, we were talking about Zomato and Nykaa and all. Today we are talking about public sector bank. Just see the contrast. How, what do you expect? I mean, fund manager cannot move 1 lakh crore from, I'm not saying that Zomato and Nykaa, but say from Avenue Supermart or Asian Paints and all those bluest of blue chips to, some public sector banks and all. That's not the mandate. I mean, I would say that it is impossible to do it. So, but that's what market has done. So, I think there is somewhere very deep, I'm all the way growth investor, good time, bad time, but clearly somewhere value is asserting. There is a very strong value rally right now. Maybe it was overdone on growth side, and even the decline in the interest rate was also overdone. So, like whatever the pendulum is swinging from that 18%, 10-year in 81, 82 to literally 0 to now maybe 3-4%, but definitely not minus 20. So from 0 to maybe 3-4%, 5%. So there is a clearly change of cycle there, and we are still struggling with accepting it. So what has happened. But even now, today, the same companies are still cheaper than your growth companies.
True. Nikhil, is it driving local investors?
To add here,
Sure.
as a follow-up answer to your question, Udayan. In the 90s, I mean, most of us were born in the 90s in this business. And a lot of the mutual fund managers who have great 25-year records, who became CIOs and then some of them retired, I can tell you one thing. A lot of the performance actually stemmed from 4 or 5 years of from 95 up until 2000. And I'll tell you why. I'm talking the index beating. Because the tech sector, the TMT sector, okay, Infosys, Wipro, Z and all that, they did not have any participation in the Sensex. Okay, so the Sensex actually did nothing between 96 and 2000. If anything, it was probably down a bit. But everybody had tech. And they beat the daylights out of the index. Okay, they beat it by like 10-20% points every year. Now that put performance points into your bank, which you ate off for the remainder of your career for 20 years. So you cannot complain that, look, the market is moving in a direction where I am underinvested, because you were in a underinvested area which was not in the index, that did phenomenally well, beat the market. The market did not have those stocks in the index. So, the market cuts both ways. I mean, so we cannot really complain. I'm just pointing out historical facts so that we understand that the markets usually are a tricky place to be in, and we can't just make 1% for doing nothing.
True. Nikhil, is it driving a class of local investors towards passive investing? Because they look at the index and say, I pay 0.2% just buy the index, and that's good enough from these fancy investors you pay so much money for to manage my money. Is that a fair point, or do you think active investment will actually beat passive investors in the medium term?
So, Udayan, it's a tough answer because we have an active management fund.
I know.
If you look at it historically, I think passive has done better. That 1-2% a year, if you were to compound that over 20 years, mathematically, I think it is quite hard for an active fund to beat a passive fund. And
Even in India. People think it's in the US. In India, it will be different.
Well, if somebody is charging 2% every year for 20 years, that's a significant portion of your corpus. That being said, I think active does better in flat markets or range-bound markets, and passive probably does better in trending markets. Considering how expensive the markets are today relative to the rest of the world, maybe there is a case to be made why active could do better in the next 2 or 3 years when Nifty doesn't give stellar returns. But over a long term, I think passive will continue to outperform because our fee structures are not efficient enough. I don't think anybody can really bring in alpha for a client charging 2%, having a distributor in the beginning who charges a fee and an exit load and all of that. I think it will be quite hard in that model for active to actually outperform.
That's remarkably candid of you to say it because you are in that game yourself. Are you doing something to disrupt that or change that?
Well, I would say we are trying, but I don't think we're doing anything significantly different to warrant a change, to kind of, weigh the scale more towards the active narrative. We are charging much lesser and stuff like that, but I don't think that one thing is enough because we're still charging maybe 10% of carry, and to get that much alpha is quite hard over the long term.
Shankar.
I'll tell you one simple golden formula to beat the market as an active fund manager, okay? And that is if you get the bear market right. Because your biggest alpha will come when the market falls 40 and you're falling only 20 or 10. In a bull market, you will not be able to beat the index. Impossible. And therefore, if you have the skills to get a bear market right, and you fall half the market, you fall 25% of the market, you have put 20% point in the bag, and then you will gradually fritter it away over a 3-4 year period to still end up ahead in the game. And which is why it's an underappreciated skill to get the bear market right. Okay? And bull market, ultimately bull market, most people will have similar stocks. It's very hard to be away from, the consensus trade. So therefore, the skill where you can add value as an active manager is to get the bear market right. And occasionally, if you get that right, and I think every 3-4 years you will get a down year, just make sure you get that part right.
When is the next bear market according to you, Shankar?
I don't think it's happening anytime soon, which is a problem for active managers. Okay, it happened, 2 years back, in COVID. Now, if you were alert enough, you could have seen that. I mean, it was not difficult to spot that there was some degree of fall coming, not a bear market, maybe not a huge bear market, but I think from February 2020, there was enough data, and the screen was telling you from Japan up until Italy, schools are closing down and everything. I mean, that was not like a SARS virus. It was very clear this was a catastrophe, a calamity, and they would have some impact. So if you positioned yourself through some hedges, or if you could short in your structure, I think you would have made significant alpha. Right there, in a month, you could have been up 20% relative to the market, if you were smart enough to do that.
Lovely hearing your thoughts, gentlemen, and to see you in the flesh after a long time. Thank you very much, all of you. Pleasure.